Welcome to Markets Now. I'm Michelle Rook along with Ted Seifried with Zaner Ag Hedge, and we are seeing some lower prices in everything but cattle today, Ted. And let's talk about this grain trade. First of all, corn and soybeans really failing to hold any strength here, despite the fact that crop ratings have actually deteriorated a bit. So we just continue to remove weather premium. Is that justified in your mind?
Yeah, I think for the corn market, we've kind of moved past the major weather-sensitive time frame for the market, and going forward, it does look like we have a more favorable forecast through the month of August and into September. We've seen these favorable forecasts that haven't come to fruition, though. So, I mean, I think we have to take that with a little bit of grain of salt. Although it does very much feel like the weather pattern has changed rather significantly than where we were uh, in May and the beginning of June. So, yeah, I think the market is justified, at least in the corn market, to take a fair amount of that weather premium out. And now we're on a mission to go and find more demand because even though we've been seeing these daily wire flash sales for soybeans, we've not been seeing it for corn. We really, really need to see that export demand for corn. It's just not really appearing. We know that the Brazilians and Argentinians with their soy dollar corn version have been selling a lot of corn lately. That's where their focus has been. It's just such a competitive market for us right now, uh, and we need to get those sales on the books. So that's sort of the problem, right? We need to entice global end users to take a look at our corn.
Yeah. And fundamentals, because of what you just said, are very different between corn and soybeans in terms of the balance sheet here. And so that corn soybean ratio, what's going to happen with that?
Yeah, I mean that's honestly, Michelle, in the almost 20 years I've been doing this, I don't think I've seen a situation where we have the sets of fundamentals for corn and beans being so diametrically opposed, right? I mean, you have a situation where corn really needs to try to entice more demand and use price to do that, and soybeans, at least for the time being, at least until we have a really good handle on what that yield is going to be, I don't think we're really in a position to put beans quote unquote on sale. I don't think we're in a position to go and try to entice new demand for soybeans until we know we have something near that trend line 52 national average yield, because anything below that will leave us with or potentially leave us with a really, really tight carryover in soybeans, maybe even tighter than what we've seen the last couple of years while we've been enjoying these higher prices. So, yes, you had the big down day on Monday. A lot of that was tied into some softer economic data coming out of China. So maybe China might not have as strong of an appetite for soybeans this coming marketing year as what they have. Although, I think China will offer stimulus. The trade was a little bit disappointed with the sort of weakness of the stimulus package that they had been talking about over the weekend. But I think that might only just be the first part of it. So I don't know. Like I said, I just think it's too early to really put pressure on soybeans right now. And to your point, or to your question, that corn bean ratio, we generally live between 2.2 and 2.7 corn to beans. I think this is a year where we could potentially go to 3.1, 3.2, possibly even beyond that if we don't have good weather in August and that soybean yield does start to slip pretty dramatically from that 52 national average. So the weather in August is really going to determine what happens with that corn and bean ratio. I just don't see a whole lot of downside potential in soybeans in the meantime. While for corn at the moment, I do think there is some downside potential. So I think that might be a good way of playing the markets at the moment.
Yeah, so let's talk about technically the risk because corn, December corn, still holding the $5 mark, but soybeans today, here after a stronger opening, slipping below that 200-day moving average. Those are kind of key points, aren't they?
Yeah, yes, they are. So 1330 is your really, really big support point for November beans. In order to hold this overall uptrend, we need to hold that level. I think we'll do it for now. Like I said, I really don't fundamentally see a reason to go and break that between now and the end of August until at least until we really are very comfortable that we have very good weather. Let's say you get to August 20th. Um, and you have a good forecast through the end of August and into September, maybe then is when you can do something like that. But for right now, I just don't see the fundamental reason for that. Now, technically, hey, anything can happen, right? I mean, the amount of chart damage that was done on Monday for soybeans, and like you said, without reversing a good portion of that here on Tuesday, technically might be a different story. So you got to keep an eye on that. And a lot of this, we had over a $3 rally from the end of May into, just last week. And you could see it last week where, November beans tried to close over 14 and a quarter 4 times in 6 sessions. We got over it, but we couldn't close above it. And then you had that reversal lower day on Thursday. You just kind of felt like, okay, this is when, the long position is going to take some profits. This is where we're going to get our correction. And to this point, that's what it's been, a correction. Now, how deep can this correction be? Again, my line in the sand is 13.30. For corn, I think there's a bit more downside potential in the short run.
Yeah, and the wheat market certainly isn't doing any favors for corn today with some double-digit losses, at least in Chicago. Is wheat also seeing pressure, though, today from the higher dollar? Are we still removing war premium, it looks like?
Yes. So, right, the higher dollar is always going to have a bigger impact on wheat than really anything else, because wheat is such a global market. There are so many different places in the world that offer wheat for sale, and we are fairly rarely on the cheaper end of that. And especially when that dollar is stronger, that really does price us out of that global export market. So that's a problem for wheat. But also, at the end of last week, with Russia attacking the ports on the Danube River in Ukraine, we had gone home the week before thinking they're not going to do that. It's too close to Romania, a NATO country, and it's too far away for them. And nope, they did it. And so that got the wheat market super excited, but we haven't seen any follow-up attacks there, and they are continuing to load wheat on vessels out of the port of Danube. And then in the meantime, Ukraine, I'm not going to even say attacked some of the Russian ports. They sent some drones in, and there were some explosions nearby Russian ports. I think Ukraine proving a point that, hey, Russia, we can do the same thing you're doing. I don't think Ukraine wants not the right word. I think Ukraine's smart enough not to go in and full on attack Russian ports or Russian grain vessels, because the U.S. and the UN have made a very big deal about Russia stepping away from the grain corridor, saying, hey, this is Russia being a bad actor on the global scale because it's pushing global food prices higher and it's putting pressure on the countries in need, the starving countries of Africa and so on and so forth. And so if Ukraine were to do the same thing to Russia and attack ports, well, then they're being bad actors as well. And all of a sudden, now we have a rift between U.S., Ukraine, UN, Ukraine, and I don't think Ukraine really wants that. So that is I think, the main reason why we haven't seen any follow-up attacks from the Ukraine on Russia. Also, maybe why Russia hasn't been aggressively attacking that very important, that key Danube port, the ports on the Danube. And for the fact that there hasn't been an escalation since that fever pitch scenario that we had mid last week. Yes, that's why we're continuing to take some of that war premium out.
Yeah, no doubt. Plus, we do have some Ukraine grain moving, so that probably is also a little negative for that market. Okay, cattle, let's move over there. Pretty nice rally here today. Was that because we basically kind of bounced off the lows yesterday? The funds kind of defended that long position, or is the market anticipating some better cash? Because honestly, we didn't have a lot of cash last week. Are the Packers going to need some inventory?
Yeah, so very, very thin cash last week. And you've got what we'd call a game of chicken going on right now. So
Yeah.
you have Packers that want to lean on the idea that this is the time of year where demand slumps a little bit, as we've all had our fun, to start the summer, spring and summer, into the 4th of July weekend. Well, now we get into the summer doldrums, and that demand kind of cools off just a little bit, at least until we get closer to Labor Day, where we have our last hurrah again. And seasonally, these box beef prices start to come down a little bit. So that puts pressure on Packers margins, and they like to try to pull cash down this time of year. I think that's why we had such thin trade last week. They're going to try to continue to do that this week. But the higher box beef price here midday today might be enticing for them, might have to sort of force their hand on that higher cash trade. So there is optimism for that higher cash trade. I'm not so sure we're going to get it or not, but there's optimism for that. Also, like you said, funds defending that technical, that this trend channel that we've been in for a very long time in this very mature bull market that we have in cattle, defending that trend line, the reversal higher yesterday. It's it was a technical hold, so the buyers are coming. The technical buyers are able to come back in here today, and it's been a nice day. Hopefully, we hold on to that strength going into the close.
Yeah, no doubt. And like you said, choice boxes up over $6 today, but some of that a function of just the Packers kind of cutting the kills here. The hog market, let's talk about that one because we have had such a big run here. We made new highs for the move in some of these nearby contracts here this morning and have kind of since set back. Are we due for a correction, do you think?
Yeah. Well, first of all, you look at where August is trading versus October, and there's such a large premium. Now,
Yeah,
a lot of
big.
that is because we have really kind of thin upfront weights, meaning marketings are very current. There's not a whole lot of market ready animals up front, at least not a big glut of supply, which is why that August is so much stronger. But as we move from the August contract into now the much deeper volume October contract, it's a big discount. So I think there's more upside potential here in the October contract. But as far as today is concerned, we got up over the 200-day moving average, and we've kind of faded. You know, you run stops, you do things like that. It was a big technical target to go and hit and take out, but now you kind of cool off. Generally speaking, when you hit a big target like that, the first time you have that sort of fade that comes afterwards, or that cooling off. Longer term, I think we'll get up and over it again. But, you know, it would be a likely place for hogs to take a little bit of a breather and do a little bit of back and fill technical action right here.
Okay, thanks for joining us. That is Ted Seifried with Zaner Ag Hedge and Markets Now.